Hello, everyone, and welcome to the Climate Finance Reporting webinar, which is part of USAID's Climate MEL Learning Series. In today's webinar, we will look at climate finance reporting, understand what climate finance exactly is, what are the standard indicators for climate finance, and look at concepts like financial close and contribution. And we will also go through some specific investment scenarios to determine what to report and when to report. So let's get started with a quick reminder that USAID has a climate strategy that goes from 2022 to 2030, which includes 6 agency-level targets, including the mobilization of $150 billion in public and private climate finance. So today, we're going to focus on reporting as it relates to this target. So let's first ask what climate finance really means. So the UNFCCC defines climate finance as local, national, or transnational financing drawn from public, private, and alternative sources of financing that seeks to support mitigation and adaptation outcomes that will address climate change. Globally, there is a sense of urgency around climate finance because, as this graph shows, global climate finance flows need to increase by at least 6-fold to keep the global temperature rise within 1.5 degrees Celsius. Specifically in the context of the climate finance indicators, climate finance mobilized refers to finance or investments mobilized from external entities that were supported by USG assistance, directly or indirectly, regardless of whether there was a US government financial commitment. And some ways that USAID mobilizes climate finance is through technical assistance and pipeline support, addressing governance and structural barriers, convening stakeholders, and supporting financial instruments and financial investment vehicles. So before we get into what has been described as the wild, wild west of climate finance reporting, remember that every dollar that is reported towards the standard climate finance indicator demonstrates the agency's commitment to help address the global finance gap. Now let's get into reporting. We will quickly look at the standard climate finance indicators and then explore the ideas of financial close and contribution that are crucial for finance reporting. So the standard climate finance indicators are EG 11.4, which tracks adaptation finance, EG 12.4, which tracks clean energy finance, and EG 13.4, which tracks sustainable landscapes finance. And in all these cases, USAID must have contributed to the mobilization in some way. It is important to keep in mind the climate pillar or earmark of the finance mobilized, meaning that any finance mobilized must contribute to one of the climate pillars, which is adaptation, clean energy, or sustainable landscapes, in order to be reported. So for example, if a private sector partner provides a catch-all climate grant, then an activity would have to wait until the sectoral allocations are clear and only then be able to report. This also relates to financial close, and I will come to that in a bit. The other thing to note here is that each dollar of finance mobilized can only be reported once and under one climate pillar. So if there is more than one climate benefit of the climate finance result, then the activities should prorate them in order to avoid double counting the dollars. So to demonstrate prorating and double counting, let's look at a quick example. So in this example, USAID engages with a private sector partner that agrees to give a grant of $5 million for a climate-smart urban design project, which includes funding for both low-carbon electrification, which is clean energy related, and flood planning, which is adaptation related. So when reporting time comes along, the partner does not provide a clean energy to adaptation split of the 5 million grant in time for reporting. So how could this project report its climate results? Feel free to pause the video and think about the answer. But the correct answer here is option B. So in option A, we were going to report the 5 million to EG 11.4, adaptation finance, and the same 5 million to EG 12.4, which is clean energy finance, but that would be double counting the dollars. The right answer here is B, where we determine that the clean energy and adaptation emphasis of the grant is roughly equal, and so we divide it into 2.5 million and 2.5 million, and respectively reported to EG 11.4 and EG 12.4. This is because, as I mentioned, a single dollar may have multiple climate benefits, in this case, clean energy and adaptation, but can only be reported once. This is so that when and if we add across 11.4, 12.4, and 13.4, we don't double count any money. So prorating can also be done based on your knowledge of the grant, any work plans or documentation that's available for you. It doesn't need to be precise as long as we're ensuring that no double counting is happening and that we are highlighting our successes in both areas of clean energy and adaptation. This can also depend on the funding of the activity or any prior agreements on how the results need to be communicated for this grant. For more on double counting, you can look at our Climate Reporting Foundation's webinar, also available on Climate Links. The second rule for PPR reporting is that we cannot be counting our own money. This means that we should exclude any co-financing or value of in-kind support provided by other USG agencies like Department of State, Department of Energy, NREL, Department of Agriculture. In the case of multilateral climate funds like the Green Climate Fund or GEF, funds must also be prorated to exclude US government funding where applicable. So the guidance here is to first estimate the US contribution to these funds, and this information can be available online, and rough estimates are okay. For example, in February 2024, US government dispersed contributions to the Green Climate Fund across funding rounds totaled to 10% of all the country's contributions to the fund. This means that we can count finance mobilized from the Green Climate Fund. We have to exclude 10% to show that we're not counting or mobilizing our own money, that is the US government's money. In this example, USAID supports the development of a GCF project proposal. The proposal gets approved and awarded 100 million of GCF funding. At financial close, the activity can only report 90% of the 100 million, that is 90 million only. So now that we have looked at the indicators, let's look at two important concepts that underlie climate finance reporting. That is contribution, not attribution, and financial close. The first idea is of contribution versus attribution, which applies to all climate standard indicators. But it's specifically in climate finance, this issue comes up a lot since there can be a lot of apprehension to reporting, especially when other partners or governments are involved. Where there can be cases where it sounds as if we're taking all the credit or attributing the whole result to ourselves. Attribution is when USAID's intervention was the only or the main reason for the change. It involves ascribing a direct causal link. For example, USAID gives a grant for the operational expenses of a new investment fund. Contribution is when USAID's influence is only one of the many factors that contributed to the change. For example, USAID convenes a set of partners and then they mobilize finance for climate activities. What we want to emphasize here is that our standard indicators aim to capture the wider scale of our impact. When activities report to 11.4, 12.4, and 13.4, all we are saying is that they contributed to a success and did not single-handedly make it happen. In communicating these results, it can be useful to use words like USAID supported, USAID convened, or contributed to a result to make sure that we're conveying this idea of contribution and not attribution. So the overall point here is that the lack of single-handed attribution should not stop us from reporting our results and capturing the meaningful role that USAID plays in the global climate finance space. Related to contribution and attribution are the terms mobilized and leveraged. Finance mobilized is the broader term referring to when the US government support leads to finance mobilization with or without a financial commitment. Cases where financial commitment may not be involved include policy interventions, capacity building programs, enabling environment work, or other technical assistance. Finance leveraged is a subset of mobilized where US government does have a direct financial commitment. So this includes interventions like catalytic grants, concessional or non-concessional loans, equity investments, guarantees, and social insurance. But while this differentiation is important to document, remember that the standard climate finance indicators allow for any mobilized dollar, leveraged or not, to be reported. The next key concept is financial close. So, finance mobilized can only be reported under the standard indicators at financial close, which is when a binding contract or agreement is signed by all relevant parties. Examples of this can include a power purchase agreement that has been signed, a contract that has been awarded, for example, to build or install a new clean energy system, when a host government announces awards from bids via energy auctions, or other similarly definitive milestones towards mobilizing investments. One way to think about this is to think about the phases of finance mobilized. This table shows how funds can be pledged or committed, but without firm documentations. Investments could even be secured, but still not be allocated to specific projects or sectors. The table shows that climate finance results can only be reported when there are financial close documents that demonstrate the specific pillar, that is, adaptation, clean energy, or sustainable landscapes. We understand that it can be difficult to have all the final numbers and financial documents in place by reporting season. That is why the climate finance indicators allow for reporting in subsequent or later years. To learn more about the flexibilities in timing of results, please check out our extended indicator handbook, available on Climate Links. One last thing about the indicators. Activities should always report on climate finance disaggregates, which are public versus private, domestic versus international, and these should always add up to the parent indicator. A quick note here is that the public and private disaggregates refer to the source of the funding and not the recipient. For example, if USAID provides technical support for a renewable energy auction and mobilizes finance from a public utility to purchase energy from a private energy company, this would count as public finance. So now let's look at climate finance and how those indicators relate to other climate results. So we know that climate finance is a means and not an end in itself. And there are often links between climate finance and other mitigation and adaptation outcomes. This means that activities should always consider what other climate results are being generated due to the finance mobilized. For example, activities could report additionally on people supported, megawatts of capacity, projected GHGs avoided or reduced, or any of the other climate indicators. Let's look at an example. So in this example, an activity supports the financial close of a 50 million wind power project and reports it to EG 12.4 Clean Energy Finance. At financial close, the activity expects 75 megawatts of new renewable energy capacity and projects the avoidance of 3 million metric tons of carbon dioxide equivalents over the lifetime of the wind power project. So which indicators should this activity report to? So this activity can report to EG 12.5, which is megawatts of clean energy capacity, or EG 12.7, which is projected emissions avoided. In fact, when thinking about climate finance as a means to climate outcomes, remember that other USAID program areas or earmarks can also mobilize resources that have climate benefits. These earmarks sometimes have climate disaggregates under the indicators. For example, HO 841 tracks the value of new funding mobilized to the water and sanitation sectors, and it has a climate resilient water and sanitation services disaggregate. PSC4, which tracks the value of private sector resources leveraged by USG, also has a climate disaggregate. The point here is that reporting the same dollar to an EG 11, 12, or 13 indicator, as well as to a private sector engagement, water, or other non-climate earmark, would not be considered double counting. If you attended our foundation session, you will remember that the point of these indicators is to demonstrate performance. If a dollar mobilized by the private sector engagement team demonstrates their success, the same dollar can also demonstrate a climate success, particularly because these numbers will not be added up. Remember to check out our extended indicator guidance for more on double counting. At this stage, I will make a quick plug for our new Global Climate Change Extended Indicator Handbook, which I've referred to a few times. It is an 80-page document covering specific technical challenges for all of the climate indicators, including a range of challenges in climate finance reporting, including working with DFC, data collection challenges with the private sector, and reporting on specific investment scenarios like in-kind contributions, carbon markets, voluntary corporate commitments, and many more. For the remaining time for this webinar, let's dive into some specific investment scenarios and data collection approaches. And as we consider these examples, remember the underlying principles of climate finance reporting: contribution, not attribution, and determining and documenting financial close. So the first scenario we'll look at is where USAID provides enabling environment or policy support. In these examples, USAID provides policy design or implementation support, capacity building, or other technical assistance that results in later or downstream impact on market systems or investments. For example, a USAID activity may identify or recommend options for a country to facilitate access to finance for MSMEs or micro, small, and medium enterprises in target geographies or in target sectors to adopt climate smart practices. In another example, the activity could analyze the demand for finance in these sectors and identify effective interventions that will strengthen the regulatory environment for climate finance. The amount to report here would be the downstream finance that is mobilized through a policy, regulatory change, market shift that USAID contributed to. An activity can report these results if they determine that there is a plausible link or significant contribution by USAID to the mobilization of a given amount. So determining this link or the extent of USAID's contribution involves monitoring policies and thinking about the likelihood of a given policy to exist in the absence of USAID support. So some questions that an activity can consider are if USAID convened the right actors, or if USAID provided, through its own experts and partners, crucial technical assistance. Another thing to think about is how long USAID's involvement lasts beyond or through follow-on activities. The timing to report this would be once at financial close, and here, make sure that we're not reporting future investments, projected or expected investments, and only those investments that have been actualized and closed. Data collection for this may require additional monitoring of government announcements or maintaining connections in the country context or with the medium or small businesses that benefit from this policy. The next investment type we'll look at is direct private sector support. So in these interventions, USAID partners with companies to leverage their expertise, resources, and innovation capabilities to achieve climate benefits. For example, an implementing partner may work with a private sector partner to increase their investments in certified deforestation-free products. The implementing partner provides technical assistance and training in monitoring tools to guarantee the production of verification of low carbon and deforestation products. What you would report here is the value of investments by the private sector actor in the sustainable supply chain. For example, this would be the amount of investment in the product, the price premium, or the sales volume. It is important to be upfront and agree in advance on timing, methods, and responsibilities for reporting with the private sector actor. There may be cases where the private sector actor is unwilling to share any financial data with the implementing partner. In those cases, the IP may choose to use existing market data or expertise, estimates of the value of the investment, and then validate those investments with the private sector partner. The IP can then report those estimates and make sure to include a written validation and justification as documentation during the DQA. The timing would again be once at financial close, that is, when agreements, loans, grants, or internal investments decisions have been finalized. If additional funding is provided in future years, they may also be reported in the year in which they reach financial close. The next scenario we'll look at is carbon credit activities. In these, USAID provides technical assistance for the development and monetization of carbon credits to achieve local mitigation and economic benefits. For example, an activity can support the establishment of a carbon fund that works with local nonprofits to promote climate smart agriculture and sustainable agroforestry. The carbon reductions from these practices are then sold as credits to the private sector to generate revenue for more sustainable practices. What would be reported in this case would be the sales price. So now, if the credits are sold within the period of performance of the activity, they can report the actual agreed purchase price. If the credits are verified but not sold prior to the end of the activity, the price in a signed purchase agreement or a conservative market value estimate can be used. The timing to report this would be once per carbon credit. That is, the market value of the carbon credit can be reported once they are verified or otherwise ready to be issued. Again, document your sources and methods in a DQA, as well as the PPR indicator narrative. So the last scenario we'll look at is in-kind contributions. So in this, for example, an activity may support the development of a regional conference where USAID convenes two other organizations that agree to co-lead the conference without USG funding. So one partner provides the meeting space for the conference, which is valued at $62,000. The other partner might provide meals and transportation for the attendees, valued at $20,000. So what would be reported here is the sum, that is $82,000, in investment mobilized. We can use the actual or market value of the services provided. So services, supplies, real property, and equipment. For volunteer services, we can use the rates that must be consistent with the rates normally paid for similar work in the organization. Voluntary employee time should be valued at the employee's regular rate of pay. The timing to report this would be at financial close or at implementation. USAID can count the value of the contribution once the company self-reports that they have started to work on the implementation of the commitment or contribution. So as we see, climate finance reporting can be complex due to the many moving parts involved. So just a reminder to include all relevant information in the PPR indicator narratives. This includes a clear description of how US efforts have led to the finance mobilization, what partners were involved, the type of US assistance provided, if any grants were made or any funds were set up, the source and amounts of funds by actor, for example, the company name, and actor type, for example, a private bank or a multilateral institution. The character limit is 3,000 characters, and we promise that we actually read them. And with that, I conclude my presentation. I will share a few resources here, including the Global Climate Change Indicator Handbook, Expanded Indicator Handbook, as well as the Climate MEL Learning Series, which is a series of webinars that will be shared on Climate Links. Here are some more resources, including the FOLU and CLEAR tools that will help estimate emissions reductions and avoided for sustainable landscapes and clean energy, respectively. And please let us know if you have any questions. We have included the email in this slide, and we thank you for your time.